Welcome back to another episode of the Quantium Cast. I'm your host Ryan Kia, and we are going to be looking at the charts of GVC Holdings and Kaz Minerals PLC. But first, you know the drill. You've got to head on over to quantiumresearch.co.uk. That is our website, and you have to sign up if you haven't already done so. And once you're all sorted with that, make sure that you click the chart pack section and download the relevant chart pack for this episode, and that will be the chart pack for episode 11. As you get that sorted, you can either pause this podcast right here and then unpause it, or you can listen to me talk about how frustrated I am about not having enough super malts left in the fridge to last until today's chart pack episode. Don't worry about it. I should order something and use Prime, and it should come through tomorrow. If it doesn't come through, I might be quite frustrated, but don't worry about it. We've already got enough to worry about with a potential recession risk. I mean, yeah, 2-year and 10-year treasury notes, or at least the yields, have inverted, but don't worry, we're still alive. Look at your portfolio and see, yes, we may likely be down today, but it's not that bad. Anyways, let's get into the chart. So, beginning with section 1, we're looking at GVC Holdings, and the ticker symbol is shown in brackets, GVC. We can see that there's been quite a choppy trend, in fact, with highs at around 725 pence per share and lows for this period we've mentioned at about 500 pence per share. And this period began March 2019. And right now we are on the 15th of August 2019. We can note that the 20-day moving average and the 50-day moving averages are turning down, and they have been turning down for about 15 odd days since the beginning of August, which is quite bearish, and the price had actually been walked down as a result of the 20 MA crossing under, or we could say the 50 MA crossing over the 20 MA. In this case. However, it could be noted that the MACD is turning up a little bit, and today's report was quite positive, as we'd mentioned in episode 11 of the Quantium Cast, that the company had not done as bad as expected. In fact, they had beaten the forecast set by analysts by, I believe, £10 million above the forecast earnings before tax, depreciation and amortization, otherwise known as EBITDA. So it's possible that this company could have its shares break through that 20-day moving average, which is the orange line, and potentially break through the 50-day moving average to target recent highs that can easily be seen by the chart around the range of 675 to 725. That would be a hard level to break if it were to break through. At the moment, though, there isn't enough momentum. The price towards the end of the day had been sold off. In fact, the shares peaked at 588 odd in the morning, and right now, as we've noted, they're at 559, and the time is 4:25. So we have a couple of minutes left till close, and it's not the greatest candle to end the day on, surprisingly, with such a good report and analysts giving this an upgrade. At least Barclays had upgraded them before they released their report from £11 per share to £11.30. But we must look at this share from a balanced point of view. So if the share price were to fail to break through the 20-day moving average, as shown by the orange line, then the price would likely fall back towards prior lows and test that support of around 500 pence per share, as you can look back to around the period of March the 18th to the beginning of April. That area, or what is right in between there, shows the lows for this period. Two simple setups then could be to go long at a break of the 50-day moving average, the cyan line has shown, and target one of the previous highs dependent on what tighter time frames they're telling you, or just short on a retest of one of these averages dependent on, once again, your conviction and risk appetite. For example, if you are very bearish on the stock in the report today, although it did beat expectations, you could short at the 20-day moving average, or you could short at the 50-day moving average if you want to be extra safe. And if that breaks, put your stop loss a little bit above so you don't really lose much either way, and you could catch the proper trend reversal by only losing a couple of percent a couple of times in a row to eventually catch a movement that could be up to 10%. Okay, now moving on to section 2, we're going to be looking at Kaz Minerals. The ticker symbol is shown in brackets. We are once again looking at a daily frame, and this chart in particular shows the 20-day moving average and the 50-day moving averages turning down. So it seems that there is a little bit of bearishness about the stock. The stock didn't return profits as expected by analysts, and we can see that the reaction was bad because the price is down about 10% odd today, and it's very likely that the price will continue to fall into the final minutes of market, as we can see that there was a harsh reversal candle. In fact, that's the one right now that lines up to show the current price at 440.5 pence per share. We've noted the first level of support could be 370 pence per share, and resistance right now is decreasing at quite a rapid rate, but it's quite balanced between them. The MACD has turned bearish, so if you are looking to go long on this stock, it is setting up for lower lows but potentially lower highs as well. So if you go long at say 370 pence per share, you could target a high to be tested of around 500-ish, plus or minus 5 pence per share, and go there and get a hefty reward, capitalizing on say commodities remaining strong. But at the moment you have a lot of risks with this company. It is, and this is not just with relation to the index, but they also acquired an asset that had quite high costs, and the market seemed to have not liked that update, and ever since then the shares have been battered. In fact, they've fallen off a hill from highs of above £10 per share to the current prices of 440.5 pence per share, meaning it has dropped more than 50% off highs, which is quite worrying for investors. However, it had rallied from about 100 pence per share to there as a result of 2016 to 2017. In fact, the rally from 2016 to 2018 in commodities, one potential setup on the daily would be to go short on a retest of say the 20 or 50 day moving average, once again dependent on your risk profile. If you have a lot of conviction that the stock is going down, at any retest of say the 20-day moving average or even anything near to it, you would look to go short, or at least from a risk management perspective, you would look to go short with a starting position and then increase that position on a test of the 50-day moving average. Let's have a brief look at chart 2.2 though before we finish. This gives a tighter time frame. Each candle represents, I believe, an hour on the chart, and we can see that resistance around here is still the 20 and 50-day moving averages respectively on the way up, and those, you need to break those levels for the long side and consolidate on them as levels of support, or otherwise if they don't break or if they don't hold once broken, they look to just be resistance levels again when the price breaks beneath it. At the moment the MACD is close to turning upwards, so we can see that there may be potential for a long, but at the moment I see there is still some room left to go. So the price could continue to fall towards that bottom green trend channel line that we've put at anywhere from 370 to 375 pence per share. But the reward at the top of the green trend channel line goes anywhere from 525 to about 550 pence per share. But once again, you must remember that the moving averages will be turning down. So those will be your resistance points if, say, you decide to go long on a bounce of the channel. So you'd have to break those levels and once again target the optimum closing position at, say, as I mentioned, 525 to about 550. But if you're on the short side, at the moment you'd probably hold your position. If you're looking to open a short, you, as I mentioned earlier, would open a starter position, say at a retest of the 20 MA, and if not the 50 MA, once again dependent on your risk profile and also your conviction on the stock, whether you're extremely bearish or whether you're only trying to get a scalp on the position. I did mention earlier that the MACD is close to turning up. Once we see a cross, it's likely a situation where there could be a shot at a potential trend reversal, because right now we're seeing the whole situation of lower lows and lower highs on the chart, In fact, if you go from left to right, you'll see that. One thing I haven't talked about is the volume. And if you look at the past 6 or so candles, you can see that there's a general trend of a decrease or reduction in the total volume. And you're starting to see price action weighted towards the sell side. In fact, there's a greater volume at the moment of sellers than buyers, as shown by the most recent volume candlestick, and I assume that will push the price action towards the bottom green trend channel line, which is about, as we said, 370 to 375 pence per share, depending on when you're looking at it. So that has been it for episode 11 plus of the Quantium Cast. I've been your host, Ryan Kia, and I think I've found the best place to get a super malt from. Until next time.